Perfect. Good afternoon, everybody. It's my privilege to introduce our guest speaker for today, Tyler Block. He is a managing director at Sutton Lucas, which is an investment bank that specializes in mergers and acquisitions. He first began his journey in finance in about 8th grade after watching the movie The Wall Street, which I believe came out in 1987. Correct me if I'm wrong.
Right.
Yeah. But he quickly realized that it's not all about chasing the money. It's about finding passion, precision, and purpose within it. And what I find most striking about Tyler is not only his scale of transactions, but his philosophy. He really practices what he preaches when it comes to the world of M&A, and he's going to share more about that. So if you guys will all join me in welcoming Tyler Block.
Running. So today we're talking about M&A investment banking, and Adrian was kind enough to give me some guidance on what it is the room collectively was hoping to learn. But there's a lengthy Q&A session at the end, so if you have specific questions, I'm happy to answer those. In the meantime, I'm hoping what you'll see in this presentation will give you a sense of what M&A is like and how we do what it is that we do. And so what we're going to be talking about specifically is the roles and responsibilities primarily through the lens of a junior banker, which for those of you who might end up in investment banking will give you a sense of what your daily life might look like inside an M&A team. Then what a team structure looks like, essential tools required to do your job, culture and lifestyle inside banking, the challenges that come with banking, but then of course the rewards and career growth, and some takeaways. Then from there, I'll defocus away from what it's like to be more of a junior banker or a team member and into specifically my path into banking, my company, some case studies, what a transaction process looks like, and then of course we'll end with Q&A. And so starting with what is M&A investment banking? Basically what we're doing is we're putting together big companies with still bigger companies. And so where I operate in a part we call the middle market, from a transaction size perspective, these tend to be at the low end transaction values of about $20 million, and at the high end usually top out somewhere around $200 million. So a garden variety transaction, a typical one's going to be somewhere between $50 and $75 million. That's most of what I do. And so I work on what's called the sell side. So we represent sellers exclusively in ultimately seeking liquidity. That can either be through a recapitalization, meaning they sell less than 100% of their company, or a full sale, meaning they sell it all. And so there's minority and there's majority recaps. And so the difference there would be control. Control is at 50.0001%, and there's a premium for that. And so ultimately, though, what we're trying to do is match the best acquirer for the company, and so we'll run an auction-based process. And so we're usually selling to a mix of strategics, which are exactly what you think they are. They're bigger companies doing exactly what it is that this company does, or even maybe a larger breadth of service, and they're looking at a smaller company either for geographic expansion, capabilities expansion, or skill set expansion, typically, or it'll be a private equity group who would be looking at this as a platform, meaning this has enough size, scale, and scope inside the company that you can then grow it still further, and then they'll sell it to either a larger financial or then strategic investor, or possibly take it public. And then family offices, they'll just buy and hold forever. And so we'll go to a mix of all of those. So where I work on the sell side, there's a bunch of, think of it as swim lanes. The very biggest swim lane would be the banks that you are probably very familiar with, like Goldman Sachs or JP Morgan, Citigroup, Morgan Stanley, and some others. Then as you go down from the multi-billion-dollar transactions into maybe the $1 or $2 billion transactions, or ultimately into the hundreds of millions and lower, you'll see specialist banks like Evercore, Lazard, Moelis, Baird, William Blair, Houlihan Lokey, Harris Williams, Canaccord Genuity, and us. And there's a lot of others, but those would just be some well-known examples. And so the people who actually make these deals happen are at various career stages. So the first stage, before you can be an intern, but the first real career stage where you've been hired into the company on a full-time basis is as an analyst. And so an analyst, basically what you'll be doing is you'll be building a lot of financial models. It's like a financial modeling boot camp on steroids, and it lasts somewhere between 2 and 3 years, after which you'll be expected to go to business school and get your MBA, or a very few are sometimes offered a promotion straight to associate, or sometimes they'll move from the sell side to the buy side. Buy side examples would be at the very largest, like Colbert Kravis Roberts, Clayton Dubilier Rice, Forsman Little, and some others, and then there are lower ones still, and there are specialist ones on the buy side. But essentially, in addition to creating very, very comprehensive and detailed financial models, you'll also be creating what we call pitch books. So the primary job of a managing director becomes getting new clients, otherwise nobody has anything to work on. So what we'll do in an effort to win the engagement is put together essentially a 60 or so page deck talking about our team, where we are in the league tables, past transactions that we've done, case studies, evaluation, most likely selling price range, what a process looks like, and so on. And so it has to be letter perfect, because anything that's off, whether it's mispunctuation, whether it's misspelling, it's going to make you look sloppy, and you can't have that. And so attention to detail is paramount, and it starts with an analyst. And so you'll also, as you get more senior responsibility, so after your first year into your second year, you'll be trusted with some of the qualitative work as well from a first draft perspective. And so you'll be doing things like running valuation comps, you'll be looking at precedent transactions, you'll coordinate due diligence materials. So for instance, once we have a company, once we've signed what's called a letter of intent, we then enter into exclusivity. In exclusivity, that now means all the claims and representations that we've made about the company are going to be verified. And so the first thing that starts is you'll get a huge list, a due diligence list, of all the information that the buyer, their lawyers, their insurers, and their commercial bankers are looking for you to provide to them, so they can begin the work of verifying those claims and representations. And so you get the fun task of going through those and figuring out which ones are applicable, which ones aren't. But as an analyst, it doesn't start and end with you. You'll have a team over you that's been there, that's usually started their careers as an analyst as well, and it's just progressed. And so the next stop, usually after MBA school, is going to be that of an associate. And so here you'll be doing more of the qualitative work, but you're overseeing the quantitative work that the analyst will also perform. So you'll be doing things like reviewing the models. Your fun there is like finding a conditional nested if loop, seeing if there's maybe a sign for why is it the numbers don't work, just to give an example of what it is you'll be sorting through. You'll start with taking notes on client interactions. Most analysts aren't on calls, though they might be in the room, they certainly aren't heard. Associates might maybe be. You'll be supporting the vice president who will be running the day-to-day process of, so I call it kissing the frogs, and you'll kiss a lot of frogs. We'll go to upwards of 100+ potential acquirers, all in a qualification exercise to try and see not only who has the financial wherewithal to effectuate a transaction, but also trying to get a sense of price, terms, fit, and reporting responsibilities. Different sellers will have different goals that they're trying to achieve in any transaction. And so you'll start to get a feel for how to marry one versus the other when we put together ultimately what will be an enterprise value comparison matrix when comparing offers one against the other. But you'll be the one taking notes once you're an associate. You'll be the one also who will be responsible for the data room. There are 2 data rooms. There's one when we're going through a sell-side process, trying to figure out who the ultimate acquirer is going to be that we will go into exclusivity with. But then while we're doing that also, there's what we call a data pack. So they'll want to see essentially on a monthly updated basis how the company is progressing through what's usually a 3-month or 90-day marketing window. And so then you'll also curate the buyer lists. And so these are all the potential acquirers that we will market to. And so that's one where there will be multiple review sessions to figure out, are we sending these materials to those who should be taking a look at the client that we are representing? And if so, if they're not responding, who it is that hasn't responded, where they're stuck, and so on. That way, when we have weekly client update calls, you're the one who's updating the weekly tracker and also internally the CRM to make sure that we are effectively running our marketing window and not letting anything slip through the cracks. Once you've been an associate for a few years, you can expect, by the way, you'll be working somewhere on a light week, it'll be about 80 hours. On a heavy week, it'll be about 110 hours. It'll just be about the transactions, the volume of transactions that we're representing at that time and what stage they are in the process. So as a vice president, you're overseeing the team of analysts and associates. So one vice president's usually on a deal team, usually at least 2 associates and at least 2 analysts, could be larger depending on the size of the transaction and its complexity, but a skeleton team would be 5 juniors. Junior is VP and below. And so you, at this point, as the VP, you're the one who sleeps the absolute least. It's the hardest position, but the most important position from a deal execution perspective on any transaction team, because you're the one who has the primary kind of boots on the ground, where you're having the initial conversations with all the potential acquirers, and usually you're talking to somebody who is kind of at a VP level there as well for the beginning transactions. The directors and managing directors won't start getting involved in that transaction until we start to see an indication of interest. So that's when we're normally will provide a process letter once we send our marketing materials along with the teaser. We send a teaser and an NDA. Once the NDA has been executed, they receive the SIM and the data pack along with the process letter. And so in the process letter, we give dates. And so the very first date is what's called an indication of interest, or IOI date. And so we want to run an efficient process and only spend time with those who have really shown investment into the process. Otherwise, you'll be talking to a lot of people ineffectively. And so if you don't get an indication of interest, a managing director is not even going to think about picking up the phone to talk to these people unless it's such a high value acquirer that it's kind of a condition of their acquirer's process that it's a senior to senior call. That is sometimes the case, though that's more the exception than the rule. So what happens then is once the VP has had all the primary interactions, we now start to have what we call our cut. And so we'll look at all of the indications of interest in the typical process, depending on just how desirable or thin the desirability is for the particular asset that we're representing. We'll usually get on a low end about 7 offers, on a high end maybe closer to 15, and we're trying to send out somewhere between 60 and 100 SIMs. So it's a funnel, it'll narrow its way down. And so the senior attention starts coming once we've gotten to indications of interest. Now that we've gotten some investment in the process and we know who the true runners on the track or players for this asset are going to be, it starts to become more of a senior to senior interaction. So we'll be talking not just, let's say for instance, it's a PE portfolio company, meaning a private equity group has a large company that they're trying to scale over typically about a 5-year hold period. Could be shorter, could be about 3, could be longer, could be about 7, but most typically about 5 years is how the internal rate of return equation maximizes returns for that private equity investor. And so depending where they are in the hold period, that'll tell you just how much of a runway you have as a seller for rolling equity. And so all of these things enter into the conversation when we're trying to get a sense of the price and terms, which usually have 3 levers that are indicated in that IOI. So the first, of course, is cash at close, and that's kind of the one that garners the most attention and appreciation from your seller client. But then typically along with that, we usually are selling an asset that is on the ascendancy, meaning a growth company. And so there's a difference between where they are today and where they will be tomorrow, and what you're really buying as a buyer is a future stream of expected free cash flow discounted back to today's dollars, or what we call a net present value. And so it's just an argument of how likely is this asset to achieve that result. And so usually on the buy side, what they'll be doing are multiple iterations that come in at least 3 flavors, what's called a downside case, meaning what happens if something goes wrong, a base case, meaning this is probably about a steady state, what we expect the company to do, and an upside case, meaning what happens if some large pipeline opportunities, maybe in their sales pipeline, convert, and now it exceeds forecast expectations. So these are all the things that go into the 2 other levers, which would be either an earnout, which nobody likes but everybody recognizes is a way to bridge the gap between where a client is and where the client will be. And then there's ultimately something called rollover equity. And so this could be if I sell my company, and I own 100% of ABC company, and I'm selling to XYZ company, I no longer exist as ABC company. They're going to dissolve me, and I'm going to essentially roll either my stock or my assets into a new co or new company, and then ultimately I'll then be acquired. And if I roll equity, let's say 25%, the question then becomes, what is the 25% of old co worth in terms of share price of new co? And that becomes a contentious kind of fun negotiation that again would be at a senior to senior level. So these are the process points that either a MD or partner will typically negotiate, and that gets reflected ultimately in the LOI and in the purchase agreement. And all through this, as you could imagine, it's not just about the numbers, but imagine, if you will, a seller, somebody who's run this company 20, 30 plus years. They've foregone the comfort and security of a corporate job to take something typically from idea to large institutionally attractive enterprise. They most typically, if they're a first-time seller, have 90% plus of their liquid net worth tied up in this one illiquid asset, the company, that we're helping to seek liquidity for. And so you could imagine there's some emotions that run through this, and there's some moments of questioning, some moments of doubt. And so your job is to make sure through what is usually a 9 months, a year-long process that ultimately you're able to hold their hand through this pitfall-infested jungle that we call an M&A process, and make sure they come out on the other side of it with the millions of dollars that it is that they hired you to ultimately achieve for them. And so there's a lot of armchair psychology and psychiatry that goes along with this. And so that's once, of course, you've won the engagement and have gone down the process. But your primary job as a senior, in this case as a managing director, is to bring in new business, or otherwise nobody has anything to work on. And so that's a little bit about the roles and responsibilities for what makes up an M&A team. And so the daily workflow as an analyst, this is what a typical day is going to look like for you. So most are expected to have a typical presence about them. So there's no nice way to say this. There really aren't any out of shape. There are no fat analysts. And so you are expected to present yourself in a certain way and to have a certain look, especially if the ultimate goal is to become somebody who will ultimately one day bring in business to the company. And so the question is, do you have a certain executive presence about you? If you don't, that's not going to bode well for you. So most analysts I know, they're up very early. So when the day is clear, they'll start their day, and usually the first thing they do when they wake up is hit the gym. So the gym's usually about an hour-long session, and then from there they're going to get to their desk. They're going to be getting ready for the day, so they'll check the emails, see what the immediate fires are to be put out, what the immediate needs are from their seniors, and they're also keeping tabs on macroeconomic conditions that might have a specific bearing on the asset that we are representing. And so they'll be checking Bloomberg News and really seeing also if there's any significant M&A activity that's happened that day where we might be able to pull a fresh comp that might have valuation implications on the asset that we're representing. Your day really starts at 8. At 8 o'clock we'll have a team huddle. We'll talk about essentially the goals we're looking to accomplish in that day, what the expectations are for you to finish your task list basically. And so it's going to be a pretty quick, pretty blunt meeting where it's like, you're going to do this, you're going to do that, and so on. And there will be a checkpoint, usually sometime midday, usually around lunch. But in the meantime, now you get to work. So you'll, as an analyst or an associate, you'll be updating the models, you'll be looking at the comps, you'll be working on the actual deliverables, there'll be internal reviews. We'll be in various stages, whether it's quantitatively through a model or qualitatively through a sim, possibly a teaser, possibly a pitch deck. You'll be essentially performing your part in all of that. And then you'll have a very quick lunch. This is usually, you'll run out somewhere if it hasn't been Uber Eats in. But typically, if you're the analyst, you're the runner. And so you're going to get everybody's lunch. You'll pick it up. And you'll be delivering it to the office. Somewhere, usually midday, that pattern will repeat itself, usually around 3:30, 4 o'clock. Somebody's going to send you out to Starbucks to go get drinks for everybody. But after lunch is over, there's a lot of client calls that you might be on. There's a lot of tracker updating, a lot of CRM updating. So as an analyst or associate, you're doing that in addition to, of course, your deliverables. And so you're not done. Once that's over, you might be doing a printer run for tomorrow's in-person meetings. And then after you've gotten everything from the printer before they close, you'll come back. There's still more work to be done. And depending, especially if we're in diligence, you're probably going to be getting even less sleep than this. You'll be doing a lot of that work. So it's very demanding, especially at the junior level. There's a lot of work to be done for multiple concurrent deals that are always being run. You'll never have the luxury of only being on one deal. You'll probably be on 5 or 6 as an analyst or an associate at any one time. So that's a lot of tasks to be done on those deals. And so what about your weekends? There's like a high chance, at least 50%, maybe even up to 80+%. So just think you'll work at least half your weekends, maybe 3/4 plus of your weekends, just depending on the transaction volume. And every year, me personally, even as a senior, I think this will be the year I get to enjoy Christmas and New Year's. It never works out that way because we're always trying to get our transactions closed before the year closes, and there's always that 1 or 2 that are hanging out. And so hours, by far, bar none, number one reason why most analysts tend to say this just isn't for me. And so I'd highly say, recommend that if it's a job where you just don't feel a calling, this isn't something that, think twice about it, because unless you really love it, you're going to be wondering, well, you've been up for maybe 72 straight hours, and that's not a joke, that's not an exaggeration, you will do that. You'll be wondering, why am I doing this? And so there are rewards for it at the end of all this, but you will be drinking through a fire hose. And when you start to look at what New York analysts get paid and think, well, this is pretty good, when you break it down on a per hour basis, you probably get paid more doing other things. So you're not really, it's a nice amount. You'll have no time to spend your money, so you will save money, but it's going to be a demanding first couple of years as an analyst. So from team structure, it's kind of a staffing model type structure. And so usually inside of an investment bank, you'll have various industry groups. So me personally, I lead the U.S. Staffing and Services group for IT staffing and services. And so there's, of course, many other types of companies. So there could be a pharma group, there could be a healthcare group, in our case there is. There could be a semiconductor group, there could be a travel and entertainment. There's any number of ways where you can divide this vast array of businesses that are of an investably, institutionally attractive size into what verticals that they'll ultimately fall into. And so there's a famous saying that you should know something about everything, but everything about something, and that's the philosophy behind these industry groups. You should know all the players in that industry, you should know all the executives there, and ultimately it becomes a very small world, and your job is to navigate that very small world in such a way where you ultimately get the best result that you can for your seller clients. And so the time to learn this business is when you're young. First, you have to learn that you don't even know how to properly represent a company. You have to break it down into its numbers, but then there's a storytelling aspect that ultimately will get the premium enterprise value for the company on top of what just a multiple on an EBITDA might look like. And so what is the strategic reason this company needs your asset, and can you articulate that to them? By being able to do that, you'll bring more potential bidders into a process. By bringing more potential bidders into a process, you'll have more bids to leverage against each other. And by having more bids to leverage against each other, of course, you'll get a higher enterprise value, and you'd be amazed how many more transactions close when they're at a higher enterprise value rather than you're maybe got one, possibly two offers that are very mid and are not quite up to sellers' expectations. So the industry groups are really the way to understand, first off, when you represent a company, when we're in that pitch, when we're competing for the business, not only why we think the valuation is what it is, but why we specifically would be able to help them achieve that better than all of our other really well-qualified competitors. And so that's where the league tables come in. And so first you'll learn how to tell the numbers part of the story as an analyst. And that's going to take you a good year and a half before you get really good at that. By a year and a half to by the time you're a senior analyst, you could basically teach this stuff, and you could probably teach at this school. But you don't know everything yet. There's the qualitative piece as well, and that's really what you'll focus on as an associate. And so by the time you've learned how to really tell a story, not just through the numbers, but through the synergies, through the strategic fit, and all of that, that's when you start to get kind of how this works. But then you need to be in it long enough where you'll know where all the executives that are in this space, it's like being at a poker table and knowing the proclivities of all the other card players around you versus just showing up and expecting to win against, say, whoever the champion, World Series champion of poker is. It's probably not going to go well for you. And so the more hands you play, figuratively speaking, the better at the game you will get. And so vice presidents they're in a dangerous area. Usually by the time you're a senior vice president, you think you could do the job better than the MD. And maybe you could as far as a process standpoint, but what you're not really even acclimated to yet is how do I go out, whether it's to a trade show or an industry group or any of these other things, how do I mingle among the crowd and ultimately create a network where I create a flywheel when these companies are either selling off a division or for the founder-led companies, if they're actually selling their company, why would they come to you versus the next guy? So that's usually a VP is somewhere in their late 20s to early 30s. Your seller is usually somebody in their 50s, and there's a bit of a gender divide, not gender, but generational divide between where you are in your life story and where the seller is in their life story. So it gets easier the older you get because you have more in common with the seller. You've been around this longer, and ultimately you'll know how to present in such a way that it's compelling to hire your firm rather than their firm. And so that's ultimately what the managing director's primary job is. It's a client relationship and rainmaker's job, in addition to you've just done this process so many times that when it gets to the final kind of imagine there's deal fatigue. The buyer's been looking at this deal now for maybe close to half a year. They're getting close to the end, but maybe you're arguing over something like how much working capital should transfer, or which AR is good and which one is aged and which ones are collectible. Just little tedious issues. These are all things that could potentially break a deal outside of lawyers who love to break deals. But these are all issues that you have to navigate, and it's not like what you'll see in TV where somebody acts like just kind of a grown man-child or woman-child and they start yelling at people. Those deals will never close. You have to be very diplomatic, very measured, and present in such a way where essentially you're the voice of reason in the room. So it's a bit of a pride swallowing job, because you'll hear the angers from the buyer, you'll hear the anger from the seller. You're the one in the middle. You have to keep everybody's focused on the prize ahead, which is a large liquidity event that ultimately will work for everybody. So nobody typically walks away super thrilled from a deal. You definitely did your job wrong if somebody's super thrilled. Usually it would be the buyer who'd be super thrilled. The seller's never thrilled. Seller's usually satisfied, but never thrilled. And so that's just something where you know that when you've walked away with a satisfied seller, you've done a really good job. So the essential tools required to do this job, obviously Excel, that's where it all starts, that's where the modeling is. But you have to get really good at macros, pivot tables, offset tables. Remember those, I talked about a base case, an upside case, downside case. There'll be like 20 permutations of that, all conditionally formatted based on different pipeline, possibly converting, or different customers. You never know, especially in a services business, which is dictated by statements of work or master service agreements, just how specifically that will translate to revenue. Maybe the project starts later than what was the intended kickoff date. Maybe it starts sooner. Maybe there's more scope that you can change order for. But when you're trying to figure out 15 months or so, or even a year in advance, where they'll be next year, or 2 years from now, or 3 years from now, it's a little bit of a guessing game. And so essentially you have to show what your assumptions are, what you are tying those guesses to, and ultimately why it's a defensible model, especially when we start talking about things like earnout or equity roll. You'll also need to get really good at Bloomberg. You'll be using one or the other of CapIQ or FactSet, possibly PitchBook Pro, possibly DealCloud. These are all things that help you do things like spread comps, map out competitors, and really just position your company relative to not just the buyer universe, but the competitive peer set that you're ultimately positioning against. And so PowerPoint, as an analyst, you won't be using a lot of PowerPoint, but as an associate, you'll pretty much live in PowerPoint plus Excel. And so it's not just like, can I put together a slide deck? It's got to be like graphically appealing, letter perfect, all that kind of stuff. You will have a printer. The printer will make all the graphics. Like, I didn't do any of this stuff. I have a whole department that did this kind of stuff. It's been a long time since I've gotten my hands super dirty in PowerPoint beyond just kind of a first draft of thoughts and bullet points. But that's all the kind of stuff that as an associate, you'll be living in kind of daily. And so in addition to, of course, checking the financial models and all of that. So the soft skills, again, you've got to maintain a certain kind of decorum. You don't want your clients coming in there and saying, who's the sloppy person? Don't be that person. You've got to be up on everything. You want to be the person that essentially when it's crunch time and there's a point where the project can either zig or zag, they're wondering, do we zig this way or zag that way? That if you're the associate on the team and the analysts are looking your way, and remember I said there's usually a couple of associates in every team, you want to be the one whose head they're turning towards, not the other one. And there's always the one and the other, so be the one. Communications, communications, ideally your VP is going to hate you if they have to clean up all your mess. So when it comes to bonus time, and we'll get to that in a minute, the less work the person above you has to perform, in other words, the more self-sufficient you are, the better that will bode for you at bonus time. That's why you're working these crazy weeks, because at the end of the day, your bonus is at least as large as your salary if you perform. And so the reason you'll work like an elephant is because you don't want the VP to say, nah, never mind, you take it easy, I'm better off doing it myself. If that's the case, you'll get a low band bonus, and if you get a low band bonus, you'll wonder why they stay up all those hours. And the VP will be wondering the same thing, why did this person stay up all those hours only to give me a low quality deliverable? And so what you're shooting for is something that is so good and so letter perfect that the VP just looks at that and says, I can't do any better than that, I'm passing it up to my MD. Time management, so you've got to get really good. So think in Excel, if you're using a mouse that's unbelievably slow to go like this, learn your shortcut keys, and the best time to do it is now in college. The shortcut keys will allow you to fly around, and you could finish a model in a third of the time with the shortcut keys you could with the mouse. And so when you have little to no sleep in your day, every time-saving tip that you can do is something that will just be translated in terms of more sleep, will make you more rested, and frankly, it'll just make you more effective because you'll just have a fresher brain than the guy who doesn't, or the girl who doesn't do all that. And so teamwork is essential. If you can trust your teammate, you'll be able to break the work up. If you don't trust your teammate, and everybody knows pretty quickly who you can trust and who you can't, and you end up having to do all the work, everybody knows who kind of the softie is and who the performer is. And so I can't stress enough, especially if you're going to be going into banking, you may as well just do it right, or otherwise you're just going to spend a lot of hours spinning your wheels for little to no result. So teamwork is important, and being able to rely on your teammate is important, but most importantly, the question is, I'd be asking myself, and I did ask myself when I was a junior, if I were relying on me, would I be the kind of person that, would this be the kind of work that I'd want delivered? And so if something didn't pass muster, like if, down to like how many spaces are between words, or where the thing is on a page, it really is that level of detail. And so if you just think you'll slap something on a page and not worry about how it looks, just think the client's going to see that, say, wow, they kind of slapped through this and it doesn't look like they really care about the presentation. So when it comes down to something important, like trying to get the last dollar of working capital back into my pocket, will they care about that? Probably not. And so that little thing will stick in their mind, and it starts with the presentations. And so detail is unbelievably important in sell-side banking. Culture and the lifestyle. Everybody knows it's high pressure, it's very hierarchical. You will get immediate and very blunt feedback. You can't be emotional about it. You can't take it a certain kind of way. You just have to say thank you. And if it was negative feedback, learn to do better so you don't experience that again. If it was positive feedback, it just means you're doing something right, and keep doing that right. FaceTime still matters. So if you show up where others have come to the office at 7 and you saunter in at 8:10 and you're late for the team meeting, that's going to go noticed, like very noticed, and I would avoid that. And so then if the MD is still working, at 7, 8 o'clock at night, and that's common, if you've already left because you want to go meet some friends for some kind of meetup, that will absolutely go noticed, especially if you leave before the seniors do. And so come bonus time, that will be reflected. You will get free dinner staying past 8, and if you stay past 10, which you will most days, you'll always stay past 8 as a junior. And you'll almost always, maybe not on Friday, but almost always Monday through Thursday, you'll be there past 10 for sure. And so if that's the case, we will get you car service home. And so this is in New York, and we don't expect you to be riding the path at some late hour. And so you will have black car service. Your social life is going to revolve pretty much around any kind of transaction team, happy hours, or closing dinners. You pretty much won't have a social life for these 2 or 3 years. Maybe if you're lucky, you'll get to get away for some kind of holiday. Maybe there'll be some break for like Thanksgiving. You might get a day or two. There might be some break maybe for Christmas or New Year's. You might actually, maybe if you're lucky, if you're not on the transactions trying to close the wire, you might get that week. But count your blessings on those, because it's not often. Dress code. So you can't come into the office in like Lululemons or like jeans or whatever, because at any moment you don't know if a client's going to stop by, and they could come by any time of day. And so everybody, the juniors included, even the people answering the phones, have to adhere to a certain aesthetic standard. To go below that standard is basically to invite yourself to go home and change, because you will be told to go home and change. But otherwise, the dress is typically formal. You don't have to wear a tie in tech banking, though for, say, some of our banking, financial services, insurance type clients, they're still very much, they will wear ties. So like this kind of an outfit is kind of standard wear, so how you're dressed would all work. But basically, that is kind of the expectation. For travel, juniors, VPs might do some traveling, but analysts and associates, they will never travel unless it's some like very special circumstance. So the good news is you'll get to stay and work on your deliverables. The bad news is if you like traveling, not until you're a VP. And by the time you're an MD and you're trying to essentially rainmake, you will travel frequently, very frequently. And so, yeah, there's kind of this repeat of the same point. People joke that your closest friends become your team because you see them more than your family. That's not an exaggeration, that is fact. And so the challenges, of course, are the hours. You'll do a lot of the same tasks, some of which is tedious. You'll be doing formatting. You'll be making sure that the pages, the model terms, spreading the comps, that those, you'll see a lot of stuff like, put the comma here. Somebody else will say, no, I want to see a semicolon or a hyphen there. It really will get down to that level. And so at the end of the day, though, when the deliverable is due, ultimately the MD is going to have the call, but you have to put something on their desk that's going to ultimately be something they're comfortable putting in front of the client and signing off. So there's a high burnout and turnover, especially in the analyst pool. Most analysts who are going to leave have already left within 18 months. I call it year 2. But usually if you make it 18, certainly 24 months, you're probably going to make it for that 3rd year. After the 3rd year, you have 2 choices, well 3 really. You can leave to go to MBA school, that's expected. You can leave to go to the buy side, that's if you can get it. Or if you're invited, you can stay and skip MBA school. And so work-life balance, yeah, there is none of that. For those who like high-pressure situations and work well under pressure, this is a really good career path for you. You'll do very well. For those who don't do well under pressure and hate high-pressure situations, don't like clients yelling at you, don't like your seniors yelling at you and all that kind of stuff, might not be the field for you. And this is M&A. It's even worse if you go into trading. Trading is like the most blunt, the most direct feedback you could ever hope to see. More on that later. But it's a very up and out career path. That said, if you do find this is the path for you, it can be very rewarding. So this was, I think these stats were from Glassdoor. And so New York City M&A for 2025. An analyst typically makes somewhere between a base salary of $100,000 to $125,000 and make it as much as double that with their bonus. And while that sounds appealing, keep in mind you're probably going to be averaging about a 100-hour work week. And so if you want to divide that compensation by those hours, it's okay, but it might not be the best. Associates, they'll work a pretty similar work week, maybe a little bit less. Their base will go up, so usually you're either fresh out of MBA school or you've been promoted. And so it's a pretty decent pay there. You really start to do pretty, like VP, it's like the worst of both. You get paid maybe less than an associate, but the carrot is there. You now know as a VP that pretty much you're on the sell side. You could leave for the buy side, but pretty much going to be on the sell side. And so you've got to get really good at this. So you've got to run very smooth and efficient processes. Once you've run a very smooth and efficient process, then the next thing you've got to start doing is mapping out an industry and figuring out which industry group you want to specialize in. And so you might be across several industry groups as a junior. Usually by the time you're a senior VP, though, you've gravitated towards one where at least 65, 70% of your deal flow comes from one very specific industry group. And so that becomes ultimately where you'll plant your flag and make your career. As an MD plus, they get paid pretty well, but the pressure is on. This is very much up or out. You either consistently produce or there's no reason to keep you around. You'll get a pretty good base. Most of what you get paid is going to be based on transactions actually closing. And so the base will be a multi-6-figure base, but the bonus is really what you're in it for as an MD. So you want to make sure that your juniors are definitely doing their job, because if they leave you hanging, then you've got a lot at stake there, so you better really trust your juniors, which is why the pressure is so high all the way around. Your exit opportunities. So you most want to leave the sell side for the buy side, either to work in a private equity group or maybe ultimately one day form their own private equity fund. And so most who have started their own fund started somewhere on the sell side in M&A. You could also not do that. You could do corporate development. That means essentially a company like Accenture, an entire department inside the company that's based on the build or buy decision. This would be the buy portion of it. And so what corporate development is basically their internal M&A organization. It's very thin, but you could essentially work for a large company and essentially evaluate opportunities where they're saying, this is our roadmap, these are the goals that we're looking to achieve. Find companies that already are doing this. We'd rather buy it. It will speed up our time to market rather than it will take us years to organically develop this internally. And so the other thing you could do is go to work for a strategy consulting company like a Bain, McKinsey, a BCG, or one of the large other shops. You could go get your MBA. You could essentially forget all of that and just say, with what I've learned here, I've got all the skills I now need to start my own company. And it doesn't have to be a financial services company. It can be whatever industry group you're a part of. You'll have mapped out that industry, you'll know everybody there, and you'll have a lot of contacts. And so you could essentially just start your own company within that space. And so the key takeaways, M&A, it's hard work, it's prestigious, but it's an intense culture. The number one thing you could do is network early, and essentially where this all leads is 2 years of pain will lead to a lifetime of options. And so I'll put a pause there. I'm not sure how I'm doing on time.
We might still have around 12 minutes tops.
I'm going to run really fast then. This will be the speed round. My path to investment banking, I lead IT staffing and services for the Americas for Seton Lucas. Seton Lucas is a global bank. We have 9 offices in 7 countries. There's 120 of us. I came to the bank after first starting my career at Accenture. I was a consultant for 8 years. I was an analyst, I was a consultant, I was a manager, and then a recruiter thought I might make a decent tech banker. Accenture, as you might know, is the world's largest IT solutions company. And so I've built a practice area around IT staffing and services, which has grown to include digital marketing and MarTech. I've worked for some other banks. Here are just a handful of some of my transactions and private equity relationships. There's a little bit about the bank. So we close about 83.3% of our transactions. It's the highest in the space because, again, we're so specialized. This is a footprint of where we are. We've won a bunch of awards. We've done a bunch of deals. These are all case studies, which I'll have Adrian send out the presentation. You can go through these at some point. But I wanted to leave time for Q&A, and I'm sure there's a lot of questions. You have a transaction process from start to finish. Just know it's about a 9-month to year-long process, and these are the various waypoints along that journey. There are various things that can either inflate or deflate valuation. These are a few of those considerations. And so that was the all too fast version, but if you had any questions that you wanted to ask or any thoughts that you were hoping to learn more about, happy to entertain those at this time.
Why the shift from consulting to IB?
So these two right here are my kids, and in 2006, they were born, and I was a manager. That's a lot of travel. And so ironically, I thought that if I would go from consulting to investment banking, and when the recruiters like, well, this would be kind of cool because I was going to come in as a junior, I wouldn't have to travel, and I thought that was a plus. I didn't fully appreciate. I thought it was just people trying to scare me how many hours it was. It's not a scare tactic. That is real. And so the good news is that I was able to work those hours, but at the end of the day, I could still come home and see my wife and children. And so that was appealing to me. One thing that was unappealing to me about Accenture, and my career goal when I started was I wanted to be a partner. And I thought that would be the coolest job ever, to be a partner at Accenture. And I was well on my way. But basically, what I didn't fully appreciate as a 20-something graduating from college is that when you look at most of the population, the partner population inside of Accenture, it's not good for marriage. Their kids don't really know them. They're on the road all the time. You've heard the term road warrior. Well, they are the true road warriors. They have 100,000 plus miles per year that they'll travel. They maybe stay in a hotel 250 plus nights a year. And that really is their life. And so I had to question if I want to be a partner, and this is what comes with it, is that the road I really want to go down? The nice thing that worked out for me with being an investment banker, now I didn't realize that once I was an MD I'd have to do a lot of traveling still, but I can rely on a team that's going to do a lot of the work that I used to do myself do, but then at the end of the day is going to allow me that as long as I am really good at bringing in clients, so I realized very early on, get really good at bringing in clients, and you don't have to travel as much as long as you bring in the clients. And so in this digitally transformed world of Teams and Zoom meetings, that allows you to be a lot more efficient. So rather than just going to a trade show, and I'll do a lot of trade shows in a year, but during the week, I don't have to fly all around. I can just be on Zoom and Teams meetings, and so there's a lot of that. It's become a lot more accepted post-COVID. So I actually now do a lot less traveling post-COVID than I used to do. So pre-COVID, I'd probably be on the road only about 100 days a year, but that's still 100 days a year where I'm on the road. Post-COVID, it's maybe half that. So it's maybe 50 days a year I'm staying in the hotel.
Interesting.
So, but ultimately, to answer your question fully, I just thought it was more in line with who I was as a person. I knew that if I was going to be a rainmaker, I could bring in consulting projects for Accenture, and that would be kind of one way to do it. Or I could bring in enterprise value clients, and that'd be another way to do it. So by doing the same job, essentially it was more efficient. So, please.
I have a question for you. The slide on technical skills and soft skills.
Mm-hmm.
I'm very interested in this.
Sure.
Because I would like to know here in the U.S., especially with recent graduates, where do you think is the gap the most? Do you believe technical tools could be taught on the job and you don't really focus on them much as being, a package that the student would come with, but rather want the soft skills more? Where do you think is more important, and what's the gap currently?
So for investment banking in particular, so there's target schools, and so at the center of the target for investment banking is Princeton, Harvard, and Wharton. Then on the periphery you got like Yale, Cornell, University of Indiana's Kelley School, University of Chicago, Stanford, those schools. So as you're closer into those target schools, where they're on-campus recruiting, their career service offices have kind of figured out, oh my goodness, our students are coming in, and this is like back in my day, so back in the 90s, like they're lacking what they need to actually be successful at their job. So what a lot of these schools have done is they've partnered, back in my day it was called Deal Maven, it's since been acquired by FactSet. And so it's like a analyst training boot camp where you'll start to get the technical skills. So it starts with Excel and modeling in particular. And so once you've learned how to weave together the 3 financial statements into a discounted cash flow model and build up a weighted average cost of cash flow and all this other stuff, or perform an LBO analysis. So once you know how to do that, now you can actually maybe speak to the technical part of the interview, because if you can't speak to the technical part of the interview, it's over before it started. And so this became something that the career services offices developed just so that you could be competitive even in the interview. Now usually to get a full-time analyst position, you will have already been a summer analyst somewhere around your junior year in college. And so a lot of students, what they've done is as early as freshman year, they started just going out of pocket on their own and getting the boot camps, and then there's all kinds of coaches out there that do this kind of stuff, where they'll teach you how to pass the fit portion of the interview, the technical portion of the interview, and the competency portion of the interview. There's usually those 3. And so an example would be something like, tell me what does an airplane weigh? And so now what we're trying to figure out is, well, what kind of airplane? And is it loaded with passengers or not? And does it have luggage on it or not? So really, we want to see a structured set of thinking. And it's the same analogous to when you build a model and you have assumptions, how you tie those assumptions to facts and sources. And by getting the facts and sources in your model, that'll stand up in due diligence rather than something where it's more just not sourced. And so it starts with the interview. And so then I think Bloomberg is something you do here, right? And that's amazing.
That's my second question to you.
Yeah.
Yeah.
Yeah, Bloomberg's key. You'll be using Bloomberg and probably either Capital IQ or FactSet, most likely, a lot. And so the more experience you can get with those going in, so some of that you'll sharpen in your summer analyst program, but you should have some exposure to it. And I think there's some free stuff online, or even just YouTube videos, where you can start to at least get the look and feel. It'd be like if you were a pilot, I'd say go get that Microsoft Flight Simulator game, just to kind of get the feel for where the controls are and all that kind of thing. Same thing here, go on YouTube. Go on the websites for these companies. They'll give you demo versions of their software and get your hands dirty. Just even though you'll be bad at it at first, we all are, you'll get good with practice.
I'll give the chance to other students and I'll come back.
Sure.
Okay. So, from my understanding of IB, it ultimately just boils down to sales and being able to sell yourself, sell whatever acquisition you have.
M&A, yeah, I'd say so.
And so when you're trying to sell whatever acquisition you have to said buyers, it gets in bidding wars and whatnot where you have multiple buyers and they may be offering different, quantitative, like, just different amounts of money, different, financials overall, but then you have to weigh the qualitative as well, where you're looking at, how credible the buyer is and, what they're going to do with the company. How do you weigh that when it comes to a deal and you're like looking at a deal objectively?
Sure.
And weighing these qualitative quantities.
So I just want to make sure I've interpreted the question correctly. So you're saying essentially you've got multiple bids. How do you segregate the bids and prioritize them?
Right, like based on, because they may be offering different amounts of money, but maybe somebody's going to break down a company for parts and the other one.
That's a really good question.
Something like that.
So we put together something we call an EV, which stands for Enterprise Value Comparison Matrix. And so let's say on one end of the extreme, you've got an all-cash offer. On the other end of the extreme, you have an all earn-out offer. Let's say the earn-out offer is for $1 billion, but you have to perform Herculean feats that are unachievable to get it. And the all-cash offer, it's less. And so we take risk weighting and adjustment into these offers, plus time value of money. There's typically 3 levers. Cash at close, number 1. Then equity roll and earn-out. There could be notes and other things involved too, but those are the typical 3 levers. And so for cash at close, I mean, you could compare one to the next. So now what you're really talking about is in an equity roll, so a strategic won't give you that, a financial will. How likely are you to actually achieve the result? Usually what you're targeting is something like a 3-to-1. So for every dollar I roll, if I have to wait 5 years, I want to see $3 on the back end for that or more. And so then the question becomes, how long is your runway? If the private equity group's portco, and that's usually if you're rolling equity, what would be rolled into if you're not the platform, if you're the bolt-on. So we'll use that as the example. And then the question is are they late in their hold period? In which case I have, let's say, a year-long runway, or are they early in their hold period? So if they have a year or so in their runway, I probably don't want to roll equity. But if they have 4 or 5 years, I might, depending on who the PE is. So now the question is, not all PEs are created the same. So let's say somebody like an Insight Ventures is going to be way more credible and have a much further track record than somebody like John's fundless sponsor. I just got a PPM put together, and I decided to call myself a fund, and I just want to be like an owner-operator. And so that's one where you're not going to take those. We don't even go to fundless sponsors, by the way, but that would be an example of like somebody who you would prioritize low. But really what you're doing is you're looking at the 3 levers, you're assuming all these buyers are funded sponsors, which again, fundless sponsors don't even get a teaser. But then you're comparing the likelihood of how much earn out, how much the value is, one to the other. And usually what happens is, imagine a standard bell curve. So the same way a professor might grade students, you'll have some that are just so bad that you wonder why they bothered. You'll have others that are so good, you wonder why anybody else even came to the race. And then you'll have a bunch in the middle, and that's why you perform a regression analysis. And so they all regress towards the mean. And so that would be kind of your C student or your C offer. But ultimately what we do is first we have the IOIs, and we see kind of what our distribution looks like. Once we have the IOIs, we're going to have, like in pro golf, you'll have a cut. Some make the cut, some don't. So we'll give everybody kind of a chance to say, look, your offer is not competitive relative to some of the more top of market offers we've received. We'll invite you to increase your offer. Some will, some won't. And for the ones that don't, we thank you very much. We hope to catch you on the next one. We really appreciate the time invested so far. But it's just not efficient for either of us to continue the conversation at this point. So we'll catch you next time. And so you'll eliminate usually down to the top 3, 4, or 5, depending on just how many management meetings the seller and their team have the appetite to entertain. And so once we're in the management meetings, that's where you'll see real separation occur. Some will drop for whatever reason. Maybe it's your idea, maybe it's their idea. But what you're looking to ultimately achieve is exclusivity with the top buyer, and some that's really hard for. I'll give you an example. There was a company I sold about a year ago called Heartland IT. They're an Oracle company. Did a lot of work in Fusion, which is the cloud product, which is a lot of growth. But then they did some legacy on-prem stuff like e-business solutions, JD Edwards, PeopleSoft, that kind of thing. And we got 14 offers for that company. But when you boiled it down, there was only like 4 good ones. So imagine the bell curve. So we had a bunch of C and below students. So now we wanted to focus our time on the A and B students, and even the B students were kind of like So we had 3 that were all right there, and ultimately the seller decided to go with the one where he knew the guy, he felt most comfortable there. They're all pretty equivalent. And so that's where it's, and I'll go, so that's just one example. I'll give you another example. There is another company, there's a publicly listed company in China called BeyondSoft. They're kind of like the Accenture of China. And they have a very, very harsh work culture. And so we've sold companies to BeyondSoft, and they've also bid for companies where they've been the #1 bidder, but we didn't sell to them. And I'll just give you the quote. So the seller said, look, there's not enough money difference, and it was like a 20% difference. It was millions and millions of dollars. It's like, by the time I pay my taxes and fees and my therapist, and clean up all the blood stains on the carpets from the 3 years I have to be with this company, there's just not enough in the world worth it to me to go with those guys. So it's not just about the buck. And when I was a junior, I used to think highest bid wins. It does not. Very often cases, the bid where the soft factor is also like I like this team. I could see myself working with these guys. This culture is similar to my culture that I built here. That all matters. And very often cases, the silver medalist is the one running off into victory lane. So, great question though.
Anybody else has questions? Just have briefly, Bloomberg and FactSet. Briefly, differences, and which do you value most in your field?
We use them for different things. Bloomberg's more for news. I call it more kind of industry research, and that's good.
So do you think FactSet is more student-friendly, more...
Nothing student-friendly.
I understand. I've worked on both, but I mean, if you were to choose, which route would you go learning more?
It's like asking me who's my favorite kid.
You might need it more in the field. Is it Bloomberg or FactSet?
I'll use FactSet more for the technical part of the job, Bloomberg more generally. And so both are important for different reasons. For macro factors, for being up to date on news, for seeing what's come across the wires, Bloomberg's better than FactSet. But for spreading comps, for maybe mapping out a competitor set, especially in the middle market, FactSet's better than Bloomberg. So you'll use both. But yeah, it's definitely both essential tools for the job.
All right. Well, thank you so much. With that, Adrian would like to.
We
this is
really
from all of us,
appreciate you
and we really
taking time out of your
appreciate-
busy schedule.
Oh, you did. That was so
So
nice
we got
of you.
you a small token of our appreciation.
Thank you so much.
Of course.